$500,000 in the bank sounds like success, until you try to turn it into income. Spend it like a paycheck and it's gone in under 10 years, maybe 7, maybe 5. So, how to live off of it? Some say to put it in a savings account, others say index funds. A few say dividends. But which one actually pays your bills without running your money dry? In this video, I'm going to walk you and Josh through 3 different tiers of strategy to see what $500,000 can really do, and find out which one gives you money you can actually live on in 1 year, 5 years, and 10 years. These tiers are ranked based on how well they grow your money and how much income they actually put in your pocket. And in the end, I'll show you which tier pays you most in dividends and turns $500,000 into a $1.7 million portfolio over the next 10 years, generating nearly $100,000 in annual income. But first, you might be wondering, why are we using $500,000 in this video? Isn't $500,000 kind of a high number to even start investing? And honestly, yeah, it's a big number. It's not pocket change, and for a lot of people, it feels like something you only hit after years of saving, working, and staying disciplined. But here's why we picked it. Because while $500,000 feels like a milestone, the truth is, it's not enough to retire comfortably. At least, not without a solid strategy behind it. You can't just drop it in a bank account and expect it to pay your bills forever. Not in today's world. But at the same time, it's not some unreachable fantasy either. According to national data, the average net worth for Americans aged 35 to 44 is just over $548,000. For those aged 45 to 54, it's nearing $971,000. So if you're anywhere in that age range and you've been steadily building, chances are you're either already near this number, or you could realistically get there within a few years. And for this video, we're going to assume you've got about 10 years until retirement. Whether that's something official or just a shift toward part-time work, side gigs, or a work-optional lifestyle. That's a solid window, long enough to grow your money, but close enough that you've got to start making decisions now, especially about how that money will actually support your life. So $500,000 isn't the start, it's the staging point, the number where your money needs to go from sitting to working. And to figure out how far it can take you, we need one simple formula. Annual income divided by yield equals investment required. Take the income you want each year and divide it by the yield you're targeting. So if you're aiming for $40,000 a year and you can get a 4% yield, you'll need about $1 million invested. But if you're happy with $30,000 a year and you find a portfolio yielding 5%, you only need $600,000. That's the clarity we're going for here. Not just how much is enough, but how to make it enough. So now that we've set the bar, let's walk through the 3 strategies, or tiers, and see what $500,000 can actually do when you give it a job. Let's break down the 3 tiers and see what $500,000 can actually do. Starting with Tier 1, banking, and why it might not be as safe as it seems. Alright, so let's say you decide to play it safe. You've got your $500,000, and instead of risking it in the market, you tuck it into one of those high-yield savings accounts that are finally paying decent interest again. Honestly, it sounds like a smart move at first. Banks like Axos are offering around 4.66%, lending clubs at 4.4%, even Everbank's sitting at 4.3%. These are some of the best rates we've seen in a long time, way better than the national average, which is still below 0.5%. Now let's say you find a bank that pays, let's say, 4.5% interest. So here is what that would look like. After 1 year, your account would grow to about $522,000. That's $22,000 in interest, or about $1,833 per month landing in your account. Fast forward 5 years, and your yearly interest grows to around $27,000. That's a little over $2,250 per month. Not bad, but notice what's missing. Your original $500,000 hasn't grown much at all. The account's sitting around $623,000, but most of that growth came from interest, not any kind of compounding or real investment gains. Now, by the year 10 mark, your total balance will be around $776,000, and your annual income would be roughly $33,000. That's about $2,750 per month, which sounds okay. It feels safe, predictable, and kind of like free money, right? But here's where things get tricky and honestly a little frustrating. Because while your balance might look the same, the value of what it can actually buy is slowly going down. That's inflation doing its damage. If prices are rising at 3.5% a year and your savings are growing at 4.5%, you're not really gaining much. Maybe max 1% once you do the math, and that's before taxes. After taxes, you might not even be breaking even. So what looks like steady income is really more like treading water with a leak in the boat. And here's another problem. Your original $500,000 doesn't grow. It just kind of sits there. 5 years from now, 10 years from now, still $500K, but it buys a lot less. And unless you start dipping into it to cover rising costs, you're stuck on a fixed income while the world around you keeps getting more expensive. That's the hidden risk of playing it safe. It might feel secure, but over time, it locks you into a lifestyle that gets harder to afford, and that's not freedom. So, what's next? Well, the next tier up is what most people turn to when they want growth without micromanaging their money. Let's talk about index funds, specifically the S&P 500, and whether it can turn your $500K into something you can actually live on using dividends. But first, let's mark a mistake that many investors make. When people hear about dividend investing, the instinct is to go big. Pick the stock with the highest yield. If one company pays 3% and another offers 7%, the 7% stock sounds like a no-brainer. More income, right? Not so fast. High yields are often a red flag. Sometimes they're high because the company's stock price has crashed, and when that happens, it's usually not random. It means something's wrong. Maybe earnings are down. Maybe the business is over-leveraged. Maybe their cash flow is drying up. Whatever the reason, that high yield could be a trap, and when the dividends get cut, both your income and your investment value take a hit. Even if the company hasn't stumbled yet, an unusually high yield might mean it's paying out an unsustainably large portion of its profits. That works until it doesn't. One market shakeup, one bad quarter, and suddenly that generous dividend gets slashed, along with investor confidence. A smarter, safer path is to focus on dividend quality. Look for companies with strong financials, steady cash flow, and a reliable history of increasing payouts. These aren't the flashiest picks, but they grow, and more importantly, they grow consistently. Over time, a portfolio built on this principle will deliver more income, more stability, and less drama. Now, let's say you find a stock that pays a 2.5% dividend, growing 10% on average each year. At first glance, that might not seem impressive. In fact, it might not even cover inflation right now. But that part is covered by something called capital appreciation, and savings accounts can't offer that. While your dividend income is growing, the stock price itself is often climbing too, so your total wealth is going up on two fronts: rising income and a portfolio that gets more valuable over time. Banks don't do that. A savings account will never hand you a 30% jump in value, but a good stock? It might. In the end, I'll show you how Tier 3 pays the most and turns $500,000 into a $1.7 million portfolio over the next 10 years, generating nearly $100,000 in annual income. But first, let's break down dividend investing with the S&P 500 Index ETF, the Tier 2 route. The S&P 500 is widely known as the benchmark for the U.S. stock market. It includes 500 of the largest and most influential companies in America, across every sector from tech and healthcare to finance and consumer goods. If you own the S&P 500, you own a piece of the U.S. economy. The SPDR S&P 500 ETF with a ticker symbol SPY is the most popular way to invest in the index. It trades like a stock, has incredibly low fees, and has delivered a long-term performance that few funds can match. SPY currently trades around $625.34 per share, with a trailing dividend of $7.17 and an ultra-low expense rate of 0.09%. Over the last 10 years, it's returned 201.4%, its 5-year performance is 97.24%, and over the last year, its performance is 13.4%. The fund holds top names like Nvidia, Microsoft, Apple, Amazon, and Meta, some of the most valuable companies in the world. So let's take a real-world look at how this plays out with SPY. Right now, it's paying a dividend yield of about 1.16%. That's not huge, but it's been growing steadily over the years at 5.91% a year on average. More importantly, SPY has a strong annual share price appreciation of 11.58%, making it a powerful vehicle for long-term capital growth. Let's say you invest $500,000 into SPY. What could that look like over time? Alright, so the graph shows two lines on a chart, one green, one red. The green line is your total portfolio value. This is what happens if you invest your 500 grand in a SPY and just let it sit. No extra contributions. In year one, your money grows to about $564,000. By year 5, your investment would be vaulted at around $906,000, and by year 10, it would reach the big one, $1.6 million. That's more than tripling your money without touching it or stressing over it. This is what long-term compounding looks like when it's working for you. Now let's look at the red line. That's your dividend income. SPY isn't a high-yield machine, but it does pay out steady dividends that grow slowly over time. In year one, you'd collect about $6,000 or $500 a month. Not bad for doing nothing. By year 5, that climbs to around $7,000 a year or about $583 per month. By year 10, you're earning about $10,000 annually, which works out to $833 a month. Now, it's true, the dividend income from the S&P 500 isn't going to blow you away. You're starting around $500 a month, and even after 10 years, it's only about $833 a month. It's growing, but slowly. But here's the thing, what it lacks in income, it absolutely makes up for in total value. Because while that monthly dividend might not cover your rent just yet, your portfolio itself is doing some serious heavy lifting in the background. By year 10, your $500,000 has grown to over $1.6 million. That's a huge jump, and way beyond what a savings account can do. With the banking route, you'd end up with about $776,000 after 10 years. That's nearly $900,000 less than what the index fund earned in growth alone. So yes, Tier 2 isn't about high income today, but it sets you up with something even more powerful, freedom of choice. You have more options. You can sell a few shares if you need extra cash, or you can hold on to it and let it keep growing. Either way, your money's working harder for you than it would in a savings account. That's why this strategy earns its spot as Tier 2. It's a big step up from just storing your money, but we're not done yet, because what if you could get the best of both worlds? For this, I have Tier 3, the custom portfolio. This is where we bring together 5 carefully chosen investments from totally different industries and combine them into one simple goal: create rising, dependable income while still growing your wealth. Here's what it looks like. First up is AbbVie, a major player in the healthcare world. They take medications you've probably heard of like Humira and Botox. They're tackling serious health issues that aren't going away anytime soon: autoimmune disorders, mental health, cancer. And here's what's important, they pay a 3.45% dividend, and they've been growing that payout over 13.24% a year. To top it off, it has an annual share price appreciation of 7.24%. Next is CubeSmart, one of the biggest self-storage companies in the US. They're what's called an REIT, which means they're required to pay out 90% of their earnings to shareholders. That's great for income. Right now, CubeSmart's dividend yield is 4.88%, and they've been raising it 13% a year for the past decade. Storage units might not be glamorous, but people always need space, especially during big life transitions. Also, it has a solid average share price appreciation of 6.09%. Third on this list is SCHD. That's the Schwab US Dividend Equity ETF. This one gives you instant diversification by investing in a basket of high-quality dividend-paying companies. You're getting exposure to big names in tech, healthcare, and consumer goods, all through one fund. It pays 3.75%, grows those dividends by over 11.3% a year, and has a strong history of consistent returns. It adds stability and spreads your risk, while keeping the average share price growth at 7.86%. Then we have the American Tower. This one's all about infrastructure. They own over 149,000 cell towers and data centers across the globe. Basically, they're one of the reasons your phone, Wi-Fi, and streaming services actually work. With a dividend yield of 3.05%, AMT has compounded that dividend at a rate of 15.29% per year, while its stock price has climbed 8.55% annually. This is a company positioned to benefit from the rising global demand for data and connectivity. And finally, there's NetEase, a Chinese tech company with a mix of online gaming, AI, streaming, and digital education. It's the wild card in the portfolio, with a 2.08% dividend that might seem low until you see it's been growing at nearly 24.79% per year with 12.22% annual stock price growth. That's massive compounding potential and gives your portfolio an international edge. This is how your portfolio should look. Now, this portfolio will have a 3.44% dividend yield. So how did we come up with that 3.44%? It's actually pretty simple. I took the dividend yield from each of the 5 investments: AbbVie, CubeSmart, SCHD, American Tower, and NetEase. And since I am taking an equal amount of money into each one, I just averaged them. AbbVie pays 3.45%, CubeSmart is 4.88%, SCHD comes in at 3.75%, American Tower pays 3.05%, and NetEase is at 2.08%. Add them all together and then divide by 5, and you land at an average dividend yield of 3.44%. You can do the same to find the portfolio's dividend growth, which for this portfolio is 15.52% per year, and the annual share price appreciation, which comes out to 8.39%. Now let's take this one step further and see what these numbers actually turn into over time. If you invest $500,000 today into the portfolio we just saw, here's what happens over time. In the first year, that $500K grows to about $559,000. That includes both stock growth and the dividends you're collecting. And speaking of dividends, in year 1, you're earning around $17,000 in income, which comes out to roughly $1,416 per month. Now fast forward to year 5, the portfolio will grow to around $895,000 and pay you about $36,000 a year, nearly $3,000 per month. Now let's jump to year 10. This is where it gets exciting. Your portfolio by the 10-year mark will be valued at around $1.72 million a year. That's more than tripling your original investment, and it will be paying you around $96,000 a year, or $8,000 every single month. So, can you live off dividends with $500,000? Yes, but only if you use the right strategy. We've seen what happens when you play it safe. A high-yield savings account gives you about $2,750 a month after 10 years, but inflation slowly eats away at that income. The S&P 500, it turns your $500,000 into $1.6 million over 10 years, which is amazing for building wealth. But even then, your monthly income is still just around $833 unless you sell shares. Now, compare that to the dividend-focused portfolio. By year 1, it's already paying you around $1,400 a month. By year 5, it's paying nearly $3,000 a month. By year 10, you're collecting about $8,000 every month, while your portfolio has grown to $1.7 million. That's income you can actually live on without touching your original investment. You're not guessing when to sell. You're not hoping the market stays up. You've built something that grows, pays you, and gives you real financial independence. Don't have $500K? Click the video on screen to see how a 2 ETF strategy can turn a $10 a day investment into a retirement portfolio that pays $17,000 a month in dividends.